The passive fund replicates a particular index. Fund replicates market index such as Nifty or Sensex. These funds invest in the constituents of the selected index in the same proportion as they're present in the index. I have a Nifty 50. Nifty 50 is my benchmark, and I make an index fund which replicates the Nifty 50. That means, hypothetically speaking, if you have 5% HDFC, we have 7% reliance in my index. Also only 5%, 7%. World's largest mutual fund Vanguard, they were the pioneers in passive investment. Bogle, the founder of Vanguard, there was a Bogle theory. Also, there's the idea of passing after many. Actually, they thought that many fund management consistently failed to outperform the benchmarks over time. That's why years back in 76, Vanguard 500 index fund were launched. Imitate a market index composition. It's a co-joint twin, transparent with lower market turnover. Of course, low tracking error. Difference of return between the index and the particular index fund is your tracking error. Replicate market returns rather than beat it. They're not trying to outperform. They're basically replicating the particular index returns. Predictable performance. The index will give you 10%. So my index fund or my passive fund will also give me 10%. Buy and hold strategy. Out here, you're basically similarly copying whatever in the index is. So no in-depth research is required. It's already present. Lower cost and management fees, lower expense ratio because there's not so much of trading, etc. happening. The fund manager involvement in a passive fund is very limited. Passive funds types, index fund, which I told before, also a mutual fund that replicates an underlying market index. Index funds can only be bought and sold at set prices, and after the market closes and the asset value is announced at the NAV, at the day's NAV. ETFs, which are again gaining momentum, are also kind of passive funds. ETF or exchange traded fund, which is again gaining a lot of momentum, is a mutual fund that tracks an index but require a more hands-on approach to management as they can be bought or sold at any time during market hours. But an ETF is basically traded on the stock exchange. That means a demat account, funds of funds. A fund of fund may or may not necessarily track any index. These schemes invest in one or more mutual fund schemes. Smart beta. It is neither passive, neither active. It behaves like a passive fund, but it picks up the momentum stocks in the passive fund to generate a slightly higher return. They are non-conventional funds that mix the benefits associated passively managed fund with selection of active investment on the basis of some criteria. Let's go to this functionality of an ETF and index fund. Index fund, when you buy on the NAV basis, you can't buy today, sell tomorrow, sales after. You don't need a demat account in a mutual fund. Perfect ETF in your demat account, and you can buy at the real prices anytime, till the markets are open. Real-time trading price toward the market hours of ETF, yes. Index fund, no. Ability to put limit orders, ETF, yes. Not an index fund. Can you trade real time? Yes. Exit load is not there in ETF, but in index fund, the exit load may be there. Demat account is required in ETF, but not required in an index fund. Risk associated. First is the market risk. They have a limited downside protection as they hold on to underperforming stocks. Example, index fund of popping a Nifty 50. Nifty 50 goes down to index 50 goes down. The fund manager doesn't have the choice here to change the percentage or change the stocks because it is replicating. Liquidity risk, which liquidity risk, whether you can sell, buy or sell or not. In extreme market scenarios like a crash, God forbid, a passive fund may face higher liquidity risk and demand for them will be lower. Concentration risk. Many indices are weighted by market cap, meaning larger companies have a bigger influence on the index performance. Simple. Okay, the larger companies like out here also, 37 to 60% are basically the large companies. In large cap stocks also, 100 stocks, top 15 control the entire index. Due to costs such as brokerage fees, STP, etc., funds end up generating returns which differ slightly from the index they are following. Obviously, you are following an index, you are replicating the index, you buy and sell the stocks to keep in the same proportion. There can be certain charges, which is a tracking error. Understand, lower the tracking error, the better it is. Volatility, funds tracking, niche or less diversified. In that example, small cap or sector specificness can be experienced at volatility.